that 2015 will be marked by tighter fund flows from the United States, but more easy money may come in from Japan and the Eurozone. Where's money going to be moving? Will India be able to outdo or repeat the $40 billion inflow that we've seen so far this year? What's the road ahead for the economy and the markets? I'm joined by Shiv Puri, Managing Director of TVF Capital Management from Singapore. Shiv, many thanks for joining us on Bloomberg. My first question to you, what's the sense that you're getting? There seems to be, the market seems to be in a different trajectory from the real economy. Which parts of the market look interesting to you? Would you invest more money in India in this fiscal year?
Well, Harsha, I'd say to start off with, the market this year has been up about 31%. The Sensex is up 31%. Roughly half of the gains have come after the election and half prior. The earnings growth this year for corporate India as a whole is roughly about 15%. So if you do the math, about half of the gains are because of earnings growth, and the other half because valuations have moved up from about 13.5 times at the start of the year to about 15.5, 16 times currently. This is not, in my view, a cause for excessive concern. I think in a market there will be some corrections along the way, and that's very healthy. But if you look out into 2015, I've yet to see a market where earnings growth is getting better, credit growth has bottomed and probably going to get better, return on equity for corporate India is rising, and interest rates are coming down. These are usually conditions, very good conditions for markets, and so short-term jitters aside, I think the environment backdrop is still very healthy.
Shiv, you know, there's one sense that's sort of beginning to gain momentum here in Mumbai when you talk to corporates, is that yes, there's been a sentiment turnaround, yes, confidence is back, there is foreign institutional investor interest, but if you look at business, things are really not moving on the ground. Is that a view that you're getting as well?
I think that is generally right, but I also think that it's going to take time for that to show up in corporate India. So far, if you see what's happened in the last 6 or 7 months post the election, you've had GDP move up from the mid 4% range to now the mid 5% range. I believe it's about a 5.5% average for the last 2 quarters. But this is largely on the back of improved sentiment. Consumer in metros, which had deferred decisions, are buying a little more, and just a general slight ease in bureaucracy. But I think on the ground for corporate India, for infrastructure India, it's still some time away before we see that. Having said that, I don't think that is something that will not happen. I still believe that probably in the second half of 2015, you'll start seeing corporate capex pick up. I think probably by the end of next year, you'll start seeing the infrastructure development, the infrastructure build-out numbers start showing up in GDP. And I think if we're doing about 5.5% real GDP growth without those two sectors firing, I think when they do come online, we should add probably another 1.5, maybe even 2 percentage points to GDP.
The other view that I've heard specifically from foreign investors investing in the India story, Shiv, is that there is no alternative. Look, even if we assume the conservative number, conservative end of what you just said, and if it's let's say 4.5, 5% and not 5.5, 6, there aren't too many economies out there that's growing at these numbers. So is this a case of there is no alternative and therefore you are going to see money coming into India?
I think what that can do is that it might have valuations move up to the higher end of the spectrum over time, rather than at the lower end. So, valuations in India have been between 12 and 20 times earnings, excluding the 2007 time frame. So, if you look around the world, I mean, growth is very hard to find, whether it's the developed world or the developing world. In 2003 to 2007, India was competing for capital with other emerging markets, Brazil, Russia, China. Today, all of those markets have issues, and growth is very low in Brazil and Russia. In China, it's slowing down. They have a very big transition to make. So I think when people do look up at India in the context over the next couple of years, it should do pretty well whether it's 5% like you said or 6% GDP growth. But the other thing I think that's very important is that investors must do bottoms-up fundamental work on companies and sectors, because it's not going to be a case of a rising tide lifting all boats. It's not going to be like the previous period where capital came in and everything did well. If you look back at the market even this year, while the market's up a fair bit, the top quartile of stocks have done much better than the overall market, and I don't think that's going to change in the years to come.
Shiv, if I look at pure numbers, about $17 billion have come into equity markets so far this year. 40 billion if you take the debt inflows into consideration. Do you think these numbers are sustainable? Do you expect new money, fresh or new quality of money coming into India next year?
I believe so. I think that, last year, if you look at the numbers in equities, there was about $25 billion that came in. So it's really down 30% compared to last year, which would be surprising given the political outcome. But I think most investors are still on the sidelines. The sentiment has certainly changed. People are more positive on India, but the capital hasn't yet flown in as I see it. I also think that because in the earlier period there have been some disappointments over the last 4 or 5 years, people are taking the time to do more work. So I believe that capital flow into equities in India will certainly pick up from the levels that it is today.
What about the currency? We've seen quite a bit of volatile movement since last year. It sort of steadied in a zone of between 60 and 62. Would you reckon the currency is going to get stronger from here on, or given the dollar strength, you're going to see it get weaker?
Well, I think with the currency, there's one has to have really a short-term view and a long-term view. I think in the short-term view, the decline in oil prices is a big benefit for India. So oil prices being down $40 or so is like a $24 billion saving to India, which is 1.3% of GDP. Because of that, we might even have a current account that is not in deficit, which is very unusual for India. So I think in the short term, all of that's positive. Of course, it seems that the Reserve Bank is buying dollars, and as a result, their reserves have gone up, and the currency is where it is. I think longer term, though, despite capital that will flow in, whether it's through FDI, into equities, debt, other areas, and despite all the interest, there needs to be some structural change in India. The economy needs to get more competitive over time, especially in areas like manufacturing. We have to be able to compete on areas like that if the currency is to not do what it has been doing for a very long time, which is depreciate a few percentage points each year.
Let me focus a bit on the bond markets. We have seen, as I said, significant amount of capital coming into the debt markets. And you're also seeing a fairly interesting move in bond yields in the past couple of weeks. Do government bonds interest you? If you look at it from an emerging market standpoint, would you consider investing in Indian debt paper?
No, we don't have any expertise on the government bond market, and quite frankly don't follow it too closely, so I'm unable to really comment on that.
Sure. So if you look at the Indian market today, Shiv, which pockets interest you the most? Where do you see value?
I think the Indian markets have to be looked at really on a bottoms-up basis, which is to look at companies that are high quality, that have decent earnings growth, and most importantly, that will have the longevity of that earnings growth continue for some period of time. If you find these kind of businesses that are trading at reasonable valuations even, with a decent management team, I think those are very attractive companies and areas. And some of them would be in, for example, places like financial services. I think financial services still has a huge runway to go. It's probably one of the best ways to play consumer. It's probably one of the best places to play the growth of corporate capex. I think the runway there is going to be very, very long. You know, the Indian economy is 1.8 trillion GDP, and you know, the largest of financial services companies, private sector that is, have market caps of $30–35 billion. Very small compared to the size of the opportunity, and shows you the level of underpenetration of financial services in India.
A word
So
about
that would be one area.
Go ahead, finish your complete sentence, Ashif.
So I was saying, so you know, maybe another area would be auto components. But here again, it's very important to do bottoms-up fundamental work. There are many auto component companies that might be commodity businesses, but there are certain auto component companies that have a special niche, that dominate that niche, have very little competition, and so companies like that, I think, will do very well in the coming years as you know, auto demand picks up.